The underappreciated power of dividends. Oh my goodness. This is just, the hits never stop when it comes to dividends. All right, so this is from Lord Abbott, and you might not be familiar with them, but they're a long-standing mutual fund company. I never really gotten in Lord Abbott much when I was a broker, but they got good stuff. I like them. I haven't ever owned a Lord Abbott fund, but I've had some people who have. This dateline last year, January 27, 2020, our guide to dividend income in two charts. Instead of focusing on current yield, investors may be better served by considering the potential growth of dividend income over time. With government-related securities offering persistently low yields in recent years, investors have sought alternative sources of income. In that regard, one asset class that has attracted a lot of attention is dividend-paying stocks. In fact, as we highlighted in October 2019, the dividend yield on the S&P 500 had exceeded the 10-year Treasury for the first time since 2016. That's not that big of a deal. We are in a similar situation in 2020. It was definitely like that well into 2020. The 10-year is probably 1.5. It's still like that now. But focusing on the current yield misses out what we believe is the real power of dividends. They not only provide a source of income, but an income stream that has the potential to grow significantly over time. This is illustrated in Chart 1, which compares the annual income an investor would have received from a $10,000 investment in 1976 in the S&P 500 versus the $10,000 investment in the Bloomberg U.S. Aggregate Bond Index, the Barclays Aggregate Bond Index, a broad measure of U.S. investment-grade bonds. Assuming the investor withdraws the income each year. All right. Note the start date coincides with the inception year of the aggregate index. So assuming you withdraw all of your income. So let's take a gander, shall we? Now we just reduce this because this is, oh my goodness. Dividend-paying stocks have historically provided a growing source of income. So here's the aggregate bond, the black. Here's the blue, is the S&P index annual dividend income. All right, so what you can see here is what we're putting in: $10,000 annual income on 10,000 initial investment in 1976. The Barclays is paying, the bond is paying what's that, about $800, and the S&P is probably paying $400. All right, and then you see it going up and up and up, and then it starts going down and down and down and down and down and down. Interestingly enough, as the dividends are going up and up and up, even though the yield is going down. Isn't that interesting? So $10,000 initial investment, first year of income, there it is. First year of income for the dividends is $461. Not quite twice that, but a lot, $300 more in bonds. All right, final year of income, S&P was giving you $6,500. Barclays was giving you $200. Barclays aggregate ending value, $12,000. You start with $10,000, you got $12,000 back. Not gonna get the job done. S&P 500, even not reinvesting dividends, $358,000. Yeah, I think that's in one chart. All right, so let's keep reading. As one might expect, the bond investment paid a higher current income in the first year, as broadly speaking, bonds typically yield more than equities. However, the picture begins to change over the time. As the underlying value of the equity investment grew, the annual income from dividends soon exceeded the income from bonds, with the margin greatly increasing over the years. I mean, just look at that, man. Now remember, the yield on the bonds is higher than the yields on the stocks. But the yield is irrelevant because it's the dollar amount per share that you own, and it's rising in value not each year. Sometimes it goes down, but the trajectory is rising. So what used to be $10,000 is now worth $50,000, now worth $100,000, now worth $300,000. So even if the yield is lower than the bond rates, it's paying a whole lot more. Stop looking at the dividend yield, for heaven's sake. Let's see. However, the underlying value of the equity investment grew. The annual income from dividends soon exceeded the income from bonds, with the margin greatly increasing over the years. In fact, by the end of 2019, the stock portfolio had grown to more than $350,000 and producing more than $6,500 a year on income. If you have $6,500 a year on income on $300,000, what's your yield on that? About 2%? About 1.8%. But it's only 1.8% dividend. Yeah, 1.8%, 6,500. What is your yield of cost, though? That's what I'm talking about. I did this a video a long time ago. People go, so mad, this is not a dividend yield. It certainly is. It is a dividend yield. What's the dividend income you're receiving for the cost you paid for it? That's a dividend yield. It's really good, the yield on cost. I don't care what you call it. I'm getting $6,500 for a $10,000 investment. That's a 65% dividend yield. What about the bond portfolio? Oh, remember too, the ending market value figures reflect price appreciation only because the dividends are being withdrawn. Over the 43 years that barely changed since inception. I'm telling you, does this not prove what I've always said about bonds? Approximately 99% of the cumulative total return of the aggregate index has come from the coupon. 99% of the cumulative total return of the aggregate index has come from the coupon, not from price appreciation. Oh, for the love of the good Lord, please remember that. You're not getting appreciation on bonds. But if it's a bond index, if it's a bond mutual fund, it's the same mathematics. 99% of the cumulative total return of the aggregate index has come from coupon, going back to 1976. You are not getting appreciation. Stop with that. The income stream has declined markedly from $749 in year one to $283 in the final period. Yields for today and tomorrow. To be sure, the dividend yield in the S&P 500 has declined over this period from more than 5% in the 1970s to below 2% today. But instead of just looking at the annual yield, one might want to consider yield on cost, or the income received today as a percentage of the original $10,000 investment, which we just talked about. So here you go. You got yield on 1976 cost, 65%. Calendar year yield. So we're only getting, I don't even know what that is, 1.8%, but yet we're getting a 65% yield on cost. And remember, we're not reinvesting. We're just taking the dividend as income. If you reinvested, this puppy would be worth a lot more. I think we're done here. Do you not agree? I think we're done here. If you consider the original $10,000 investment in 1976 is now generating an annual income of $6,500, the yield on cost exceeds 65%. These numbers may be extreme due to the long-term horizon of this example, but a similar story can be told looking at shorter periods. As the value of the underlying stock portfolio rose over time, the investor earned more income from the dividend yield on an increasingly larger dollar amount. Bonds can certainly play a role, offering the potential for greater stability and lower portfolio volatility. Really? I don't know, because if you look at 2008, that's not what happened. But dividend-paying stocks can provide a source of income for many years to come. 100% right. All right, so there you go. End of story. All right, so that's our dividend income in two charts. That's all you need to know. Dividends are the best thing you can have, without question, which is why I like Wellington, which is why I like VTV. I like dividends. And I like to bank them. I don't like to bank them. I like to reinvest them. When I retire, I'll be living off them for sure. But right now, oh man, if you're not looking at dividend income, I think you're making a mistake. All right, we'll see you.